Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Let's continue to look at the CXC Principles of Accounts January 2024 paper. The focus in this session is on question 2, response, where candidates were tested on the balance sheet of a sole trader, performance of a business, which is ratio analysis, and business plan. Now, if you have missed question 1, the link is in the description below. Let's take a look at the question. And do remember, read your question first before you start working. Gigi Millie is a beauty store at Green Bowling Mall in the heart of a busy commercial center. The statement of financial position, which is the balance sheet for Gigi Millie, is provided below. You are required to fill in the missing figures numbered 1 to 5 in the following statement of financial position as at 31st of December 2023. Now, when you look at this statement of financial position, you would notice that it's presented in the horizontal format. But all you're required to do is to fill in the missing figures. And just to highlight those before we begin, that's 1, 2, 3, 4, and 5. Let us get into the first one, which requires us to find the non-current asset at cost. Now, what do we have available? We have the accumulated depreciation and the total for the non-current assets. Remember, non-current assets are the same as fixed asset. That's the alternative term. Now, if it is that we have the total non-current asset and we have the accumulated depreciation value, how do we ascertain the non-current asset at cost? This is actually the cost before depreciation. So what we're going to do is to pick up the non-current assets at cost minus accumulated depreciation, and that would give us the total non-current assets, and that is the value after depreciation. Now, if it is that you have that, then it means that you're able to plug in all that you have, and then you solve to find the missing item. In this case, we have the missing item, and we're going to use X to fill that space of non-current asset. And from that, we're going to minus the 98,000, which is the accumulated depreciation. And that would give us a total of the non-current asset value of $416,000. So basically, the $416,000 plus the $98,000 will give us the value of our non-current asset before depreciation. That is our non-current asset value at cost. And based on calculation, that gives us $514,000 for our non-current asset before depreciation. And of course, you can double check that figure. Now that we have completed the first missing item, let's move into the other, and that is to find the trade receivables. And remember, trade receivables is the same thing as your debtors. No, debtors is missing from the list of current assets. And we have available, based on information, we have the inventory value, which is a stock value. That's a closing stock value. We also have supplies, and that total with the trade receivables would give us a total current asset of $101,500. But the trade receivables is missing. How do we calculate that? So all we're going to simply do is to pick up the total current asset minus the inventory that we have available, the supplies that we have available, and that would give us the trade receivables value. The alternate to that is that you could pick up the inventory, add the trade receivables, and of course, you're going to use a variable to represent the missing item, plus the supplies, and that would give you your total current asset. But instead of going through that long route, we're simply going to use the first formula presented, which is total current asset minus what we have available of the inventory and the supplies, and that would give us our trade receivables. So in calculation, that is $101,500 minus 25,000 minus the 9,500, and that gives us a value of $67,000 for our trade receivables. So let's move into finding the next missing item, and that is the net loss for the year. So this business legitimately made a net loss. Now, what is the effect of net loss on your capital? Yes, net loss decreases your capital. But what do we have available here that we can use to ascertain our net loss for the year? We have the capital at beginning, capital at start or beginning capital, and we also have the capital value after it was adjusted for the net loss. So having those two figures, we are then able to determine what is the net loss. And remember, this net loss would decrease your opening capital. So all we're going to do is to find the difference between our opening capital and the capital after the net loss, and that would give us the net loss for the year. So in calculation, that is a 482,900 minus the 453,900, and that gives us a net loss of $29,000. Okay, now that we are finished with part 3, that missing item, we can move into 4, and that is to find drawings. But what do we have available based on this question so that we can find the amount for drawings? And do remember, drawings decreases your capital. So we have the capital after adjustment for the net loss, which is 453,900. And we also have the closing capital of 436,900. Having those figures, we're able to then calculate the drawings. And we're going to simply pick up our capital after net loss and minus the closing capital, and that would give us a drawings figure, because that's basically the difference between those two figures that we have available. That would give us the drawings. And that is a 453,900 minus 436,900, and that gives us a value of 17,000. And of course, you can always double check, because if you should take this $17,000, remember, drawings decreases your capital, from the capital after it was adjusted for the net loss, you would get your closing capital of 436,900. So as soon as you pick up the items and you put in the value, don't forget that you can double check to see if you're on the right path. So let's move into the next item that we have to find based on what we're required to do for this question, and that is to find the total current liabilities. Now, what do we have available in terms of current liabilities? We have the bank overdraft and we have trade payables. All we need to do with these two are to add them together to get our total current liabilities. And in this case, that's the 38,000 plus the 42,600, and that gives us a value of 80,600. Now, I know that you're asking if you could have used another route to find the total current liabilities. And yes, that is possible, because we have the closing capital and we have the total of capital and liabilities. And once you have those two figures, you can simply calculate what is current liabilities. And that is to simply find the difference between the two figures, and that would still give you the 80,600. Now you can double check to see if you are actually correct. The closing capital of 436,900 plus the 80,600 will give you that total capital and liabilities of 517,500. So we're finished with the first part of the question. Let's move into the other part of the question. And that is where we are required to use the information from the statement of financial position on the previous page, which is on page 5, to calculate each of the following for Gigi Millie as at the 31st of December 2023. And you're asked to show all working clearly. Now, the first thing that you're asked to calculate is the working capital. How do we find working capital? That is simply current assets minus current liabilities. Now, we have to go back to the question to find out what is the value for current assets and what's the value for current liabilities. So let's do that. Now, from the question, the balance sheet, our total current assets is 101,500 and our current liabilities is 80,600. We're going to use those to determine our working capital. So that is the 101,500 minus 80,600, and that gives us working capital of 20,900. Remember, your working capital is the value that is generated, that you have remaining out of your current assets, having paid off your current liabilities. Or if you should pay off your current liabilities, that is the value of what you would have remaining from your current assets, which is 20,900. We're now going to move into calculating the current ratio. How do we calculate current ratio? It's current assets divided by our current liabilities. And remember, our current assets value is 101,500 and our current liabilities is 80,600. So let's proceed to calculate what is the current ratio. And that is 101,500 divided by the 80,600. And that tells us that the business is liquid as it has $1.26 to cover each dollar in current liability. So the result is 1.26 to 1. So remember, the current ratio is expressed to 1. And we keep the two decimal places because we were not told to round off to the nearest dollar. So having calculated your current ratio, it is 1.26 to 1, indicating that the business is liquid, yes, but not too liquid. It's saying that for every $1 of current liability, Gigi Millie has $1.26 in current asset. Now, the next ratio that we're asked to calculate is a quick or acid test ratio. And for this ratio, this gives you a better test of the business's liquidity over the current ratio. So let's proceed to calculate that. But what's the formula in calculating your quick ratio, which is your acid test ratio? That is the current assets minus inventory, which is the closing stock, divided by your current liabilities. And the aim is to find out if you're to close off your current liabilities, do you have enough current assets remaining without relying on your stock to do so? No, we have to go back to the question to get the inventory value. Yes, we have the current assets and we have the current liabilities, but we have to go back to the question to find out what is the closing stock value. And that value is 25,000. So now that we have those three values, let's proceed to do our workings of the acid test ratio. And that is the 101,500, which is the current assets, minus the inventory of 25,000, divided by the current liabilities of 80,600. What is the result? That is 0.95 to 1. So this is saying, in terms of the business liquidity, the quick test, it is saying that the business would not be able to cover its current liabilities from its quick assets without relying on stock, because the business only have available for every $1 of current liability 95 cents without relying on stock. So it is unable to cover its current debts without relying on its stock. Let's move into the other part of the question, and that is for us to determine two strategies that can be used to improve performance of each of the following ratios. And from the statement of financial position, you would have noticed that Gigi Millie had made a net loss. What strategies can Gigi Millie employ in order to improve our business's net profit margin? And the first suggestion is that Gigi Millie can increase the selling price. In terms of increasing the selling price, though, This will increase the business revenue, but the business must consider, which is Gigi Millie, must consider the impact on sales volume, because if prices are too high, the business may sell less units and thus lowering profits. And I'm sure Gigi Millie wouldn't want to find herself into this position. So she has to be careful in terms of increasing the prices. Another strategy is to increase the volume of sales. And this can be achieved through marketing and sales activities, or by developing new products or services that appeal to more customers. Another way, another strategy in which Gigi Millie can use to improve the net profit margin is to take a close look at the expenses, because there may be a possibility that there are expenses that Gigi Millie can decrease. And the less expense you have, the more profit you're able to generate. And there are other strategies that could work. These are just a few. Now, in terms of the working capital ratio, what can Gigi Millie employ? What strategies can Gigi Millie use in order to improve the working capital ratio? And the first one, there's an improve cash flow forecasting. It could be a case where Gigi Millie is not doing any cash flow forecasting. Or if this is done, she might need to look more closely at ensuring that it is more accurate. And increased accuracy of cash flow forecasts will aid the business to better anticipate their cash needs and manage working capital more effectively. In this case, if it is that Gigi Millie may need a loan to improve her liquidity, then doing the forecast, the cash flow forecast, that would put her in a position to determine whether or not she would need to ascertain a loan or to find other means of having more cash available, more current assets available, as opposed to its current liabilities. Next is decreasing current liabilities. And remember, to find your working capital, just current asset minus the current liabilities. So the less current liabilities you have, then it means that the business would be in a better position to cover its current debts. It would have more in terms of its value after taking out its current liabilities, its current debts from its current asset. And in terms of decreasing the current liabilities, the business can achieve this by clearing their current debts. For example, trade payables on time, thus benefiting from cash discounts. It could be a case where the trade payables offer cash discounts if you pay within a particular period. And what this would do is to lower the amount of cash used in clearing the debts, because you're getting a discount, so you're benefiting from that discount. Clearing debts on time will also minimize late payment charges. It could be a case where there are late payment charges, and if the business does not pay in time, then there will be additional costs that is incurred. Now, if you look at the financial position, the statement of financial position of Gigi Millie, you're seeing that there was a bank overdraft. What Gigi Millie could do as well is to have an agreement with the bank to extend that bank overdraft from a short payment to a longer loan period. And that would remove it from being a current liability to a long-term liability. So those are some strategies that Gigi Millie can use to improve the net profit margin and the working capital ratio. Let's move into the other part of the question, and that is to recommend a business for Gigi Millie and give reason to support your answer. In that, Gigi Millie has been offered a space to operate a new business venture in the mall, that same mall that she has, that beauty supplies business. So in terms of a business that Gigi Millie can venture in, I would suggest a beauty salon. Why the beauty salon? Gigi Millie may have a large customer base, and offering this service would provide a convenient one-stop shop to these customers. This would boost sales for both products and services in that the person or the customers that come to purchase beauty supply can just up over to the beauty salon to benefit from the service of that personal care. And also, it could be a case where customers come to benefit from the beauty salon and they need supplies, and those supplies would come from Gigi Millie Beauty Store. So what it would do is to boost sales for both products and services, and also leverage our expertise to build a strong reputation in the beauty industry. Because selling the beauty supplies, of course, Gigi Millie is a possibility that Gigi Millie has some expertise in terms of beauty supplies. And that added to the beauty salon would boost, again, both the products and services. And the last part of the question is for you to list 2 elements that Gigi Millie should include in a business plan. So in preparing that business plan, here are the elements that you can choose from. Any 2. You have executive summary, company background, marketing plan, marketing analysis, and also the financial plan. So those are the elements of a business plan. And that takes us to the end of this lesson. Do remember, if you had missed question 1, the link is in the description below. And in our next lesson, we will look at question 3.
Like, share, and don't forget to subscribe.